So you've been working hard and you've saved up enough money for the down payment on your dream house. But you end up at the closing table with sticker shock because of all these extra costs that have been added in. Those are called closing costs. Your down payment plus your closing costs minus any adjustments that you have will equal your cash to close. How much money you actually have to bring to the closing table to purchase your new home. Today I'm going to break down the mystery of closing costs, what they are, why they're there, and then some tips on how you can save on these costs. Many first-time home buyers are caught off by the additional closing costs. In fact, more than half of all home buyers are shocked by how much closing costs actually are and how much money they owe at the end of the transaction. So what are closing costs? Well, most people know that there's a lender, there's an agent or two, there's escrow, but there's actually a lot more people involved in a real estate transaction. You've got an inspector, an appraiser, you've got a home warranty, you've got an insurance agent, and then you have the county, and you have possibly an attorney or two. These fees can vary widely depending on the area you're buying and what type of property it is. So why is it you have to pay for all these things? Well, let's go through it. First, you have a real estate agent, and they're there to guide you through the process, handle all the paperwork, deal with all of these other people that are involved in this transaction so that you don't have to, so that you don't miss any steps in it, and it kind of helps your legal liability as well. In addition, they're there to help you get the best deal. Now, it used to be that the seller paid the listing agent and paid the buyer's agent, but now as a home buyer, you may have to pay your buyer's agent yourself. Not always though. Nowadays, what we do when we write up a purchase offer, we simply include a commission for the buyer's agent in there, and that's part of the negotiation process. But that's what you're paying the agent for if you end up having to pay them yourself. Now, your lender is very important in this transaction because they're the one providing the money for the purchase of the home. There's a lot of things that go into underwriting the loan and providing you with the financing. Then there's your escrow. And escrow is kind of like the middleman, but they're there for a very important reason in my opinion. They're the ones that handle all the distributions of all the money. You're not going to deal with directly paying the seller, and they're not going to deal with trying to get money from you and handing the keys. It's actually done in a way because the escrow follows certain rules of how they handle the money. Now, once you're under contract and you're in escrow, you have a certain due diligence phase, or maybe you have contingencies, and this is going to involve an inspection. So you're going to hire an inspector to come through the property and look for any issues. They're there to find issues big and small. And what ends up happening is you can decide to negotiate based on those repairs, or you can walk away from the deal. Whatever you decide, the inspection report is simply there to protect you. It's always smart to have this contingency in the agreement. This is something you can waive, and you cannot have one. However, that's not recommended. The appraiser. Now, this is someone brought in by the lender. In fact, as a rule, the lender can't directly contact the appraiser, but one is ordered, and someone will show up and take a look at the property, and then run comps in the area based on that. And what they're trying to come up with is just the true value of the home. Is the home worth what you as the buyer is paying for it and what the bank is lending you money for? Then there's also your home insurance agent, who you're going to have insure the property. You're going to shop around for this. But this is someone involved, and you're going to have to pay the premium on the home insurance. Then you have your title agent. And your title company is going to provide you with title policy. And basically this is insurance. Essentially it's insurance saying that you're protected against any other claims on the property. They should run the title, be checking if there's any other owners, and if the seller you're buying the home from is actually the true owner of the property, and make sure there's no liens on the property. If they find liens, then you have to renegotiate the deal. Either the seller's going to pay it off, you can lower the price and pay the lien off, however it works out. but that's what title does. It protects you and the lender, making sure that there are no other owners or disputes on this property. Then you have something called a home warranty. Home warranty is something that protects against appliances that might be left in the home, HVAC, water heater. If something goes wrong with those systems within a certain time frame of you moving into the property, your home warranty can kick in. Now, home warranty is interesting because it's not always not required, it's not always necessary, but a lot of times it's actually paid for by the seller in most transactions. After all that, you also have the county. You have to record your deed with the county. There's recording fees. There's transfer tax fees. There's things that the city or county require in any real estate transaction. Attorney fees. These may or may not be involved. It kind of depends on if there's any major disputes in the deal or if anything in the contracts need to be checked out and you want an attorney involved. Most of the time, if you have an agent and a lender and you follow this process, attorneys may not need necessarily be involved in the actual transaction. But occasionally you may have attorney fees. Now, where can you find out about all these fees when you're getting ready to do the deal? Well, 3 days after you go under contract, you should be receiving something called a loan estimate. This is from your lender, and it should be exactly what it is, an estimate of all of these costs. In most cases, working with a good lender, they should probably be overestimating these costs. They run these deals all the time, so they have a general idea of what it should cost to finish this transaction. So 3 days after you go under contract, you should get this document, and on I think the second page of disclosure, you should be able to see the estimate of all of these things and how much you may have to bring to the table as far as your cash to close to get your new home. And the other thing is, as you approach the closing date, you'll get the final document, your closing disclosures. This is supposed to be given to you 3 days prior to closing, and this will have the final estimate. And ideally, between the estimate and actually on this document, it should show you the estimate amount and it should show you the final amount. Hopefully, it comes in lower on the final amount so that you're not shocked by having to pay up for anything that you weren't prepared for. So what are some ways that you can try and save on closing costs? Well, there's a few. First is lender credits. This is why it's important to shop around for lenders. See what they're offering on rates, because even a small drop can save you a lot of money. And see what kind of credits they may offer. This could be a big component in what lender you choose. Another way is seller credits or concessions. This is something you can negotiate within the offer. If you're going to offer them full ask price, but you want some of that money back to cover some of these closing costs. And to be honest, they can cover almost any of these closing costs, but there are some guidelines and rules depending on loan type. For instance, in a conventional loan, if you're putting less than 10% down, you can only get up to 3% of seller concessions towards closing costs. If you're paying 10 to 25% down, it can go up to 6%. If you do greater than 25%, it can be up to 9%. For something like an investment property, it only goes up to 2% in seller concessions. FHA allows for up to 6% in seller concessions. The VA up to 4%, and USDA up to 6%. So depending on your loan type will depend on how much you can ask for from the seller and how much of those credits can go towards closing costs. Another way of saving on closing costs is shop insurers. Home insurance is a big deal, especially right now here in California. So in California, it might be very limited, but elsewhere it's not so bad. Shop around, find the best price. If you're willing to take on a higher deductible, it might be a lower premium. Depending on your area, there's also grants and down payment assistance programs that you could use that will save you on how much money you need to bring to close. And then there's the title insurance. Typically your seller's paying for a policy and you're paying for a policy. So there's a lot of title policies going around. And so talk to your lender, talk to the title company, and see if there's a way you can work out to where you can save some money on title. Now there's some differences in closing costs. Some are upfront costs. And the upfront costs are typically your inspection, your appraisal, and your earnest money. Now your earnest money ends up being part of your down payment and is an adjustment made on your final cash to close document. But typically your earnest money is due when you make the offer, typically a certain percentage of the price. And then your inspection and your appraisal want to be paid when that's actually done. So those are upfront costs that you have. If you do a deal, you're going to be paying those as they sort of come in. The rest of the cost will be part of your cash to close. Now, some common questions are, can these closing costs be rolled into your loan? And in most cases, the answer is simply no. To wrap your closing cost into your loan, the way you actually do it is part of your negotiation with seller credits and price. Let's say you do want to get the seller to give you some credits back and cover your closing costs so that you don't have to come up with as much cash to close. Well, you could go into an offer, let's say they're asking for $300,000, you could give them $309,000, $306,000, something over the ask, but ask for that $6,000 to $9,000 back in seller credits. On a $300,000 house, $6,000 is around 2%. So you can get 2% back towards seller credits, 2% back in seller credits. That'll then go towards covering your closing costs, lowering how much money you have to come up with out of pocket. Another question is, do you have to prove that you have the money to cover your closing costs? The answer is yes. This is what the lender's checking for. The lender is going to be looking at your bank statements and your proof of funds. And essentially, they're giving you a proof of funds for not only the loan, but they're going to be checking to make sure you have enough money to actually come up with the cash to close. Now, if you're going around looking at homes or you're thinking about buying a home, a quick estimate just to guide you in how much closing costs are is typically a 2% rule. So whatever the price of the home, if it's $500,000, your down payment is whatever you're going to put down, but add about 2% of that purchase price as your closing cost. So on a $500,000 house, $10,000 is an estimate for your closing cost. But again, always talk to an agent and a lender first, and they can give you more concrete numbers on what the closing costs will be, especially because they vary so much by area and home. Well, there you have it. Everything you need to know about closing costs. I hope you found this video helpful. If you did, please hit that like button and subscribe, and leave any questions you have in the comments below, and I'll see you next time.